Okay, I guess we'll start with the NOI math homework worksheet. Go through that first. And then we'll go through the profit and loss math worksheet and then the quiz. And get started for the week to wrap up everything that you took home as homework. How do we feel about this math that you took home? Okay? Don't know yet?
I just will do
I
was pretty confident when I was doing it in class last week, and so you were like, nope, 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 and I was like, oh.
All right, so let's look at the homework section on the NOI before tax cash flow. The number one says, what's the 10% annual property management fee for a commercial property that generates a gross potential income of $15,850 monthly with vacancy and collection losses that total 7% of the gross potential? So if you think about that formula, the formula is gross potential income minus vacancy, right? Equals what? Gross effective or effective gross, either one mean the same thing, minus operating expenses equals NOI. And then that minus debt equals before tax cash flow, right? Okay? So, they want to know what's the property management fee. So, the property management fee is going to be right in here on this operating expense level. Does that make sense for everybody? So, we need whatever it takes to get down to that level because that's where we're headed. Here's what we know. We know that the property management fee itself is 10%. So, we'll put that on the operating expense line. We know that the gross potential income is $15,850 per month. So what do we want to do with that number? Multiply by 12, because everything in this formula is always annualized, right? Okay, so we want to multiply that times 12. And then we want to subtract our vacancy on the property. And what do they tell us about our vacancy? It's what? 7%. Okay, so that's all the information they've given us, and that's all the information we need to come up with the answer here. So I'll kind of make that a little bit bigger so we can deal with it here. So our gross potential income, can we multiply that out? 15,850 times 12 is $190,200. Is everybody okay with that? For gross potential income. And then we need to subtract 7% vacancy, so we've got $13,314 in vacancy. Everybody all right with that? That needs to come out. And that leaves us with $176,886 for a gross effective income. Everybody agree with that number? Okay. Now, what we know is that our property management fee is 10% of that number. So 10% of that is going to be $17,688.60. That sound about right? And that's your answer. That's your 10% property management fee. How we all do on that one? Pretty good? Okay, good. All right, number 2 wants us to calculate net operating income of an apartment complex with the following criteria. All right, so I'm going to go ahead and write out the formula before I even start dealing with all that information. So again, I start with gross potential income, and then when I subtract from that is what? Is minus my vacancy or collection losses. Yep, they all go together. And that equals gross effective income. And then I'm going to subtract out my big line item, which is usually operating expenses, right? Usually have more things on operating expenses than anything else. And that's going to equal what? NOI. And then minus any debt service I have, so mortgage payment, principal and interest would give me before tax cash flow. Now go back to the question. What answer do they want? They want net operating income, right? So again, just kind of circle, give yourself a destination, where you're headed. And here's the other thing you can do. Could I also not just kind of draw a line so that I know I'm not going any lower than that? That anything past that doesn't matter? Yeah. That's another good way to handle that. All right, so let's look at what we got. We got 70 units that rent for $1,000 monthly. And I will tell you, there's a typo on this that I meant to fix, but we'll see what you did. If you came up with a negative number, you did this one right, by the way. I meant this to be not a negative number, but that's all right. We'll see what you came up with, okay? Gross potential income. So 70 units that rent for $1,000 monthly. 70 times what? Times 1,000 times 12. What else do we know for gross potential income? 15 times what? 1,200 times 12. And what else? 2 times 1,500 times 12. So we put all those notes in there for gross potential income. And then 12% vacancy. So I'm going to make a note for myself. I got 12% vacancy right there. Property management fee of 10%. So property management fee is an operating expense, right? So I'm going to put it on that line, 10%. Annual property taxes of $43,500. Well, that's an operating expense. Did everybody get that as an operating expense? Property taxes? And then other, it says monthly operating expenses of $142,000. So if you follow the directions, what should you have done here? $142,000 times 12. I will be very honest and admit to you that I meant for the question to say other annual operating expenses of $142,000. But the question says monthly, so what are we going to do with it? We're going to times 12. We're going to take that number times 12. Now, if you didn't multiply that number times 12, you didn't really follow what the question said. Now, if you did multiply it times 12, you followed what the question said. I'll be really honest and admit I didn't mean to say that was other monthly, but since it said monthly, what should we do? Times 12, okay? And monthly mortgage payment or debt service of $7,800, well, that would be down here, so what are we going to do with it? Disregard it. It's below where we care about. Does that make sense for everybody? It's below net operating income, so it doesn't matter. So let's go ahead and start doing our math here. For gross potential income, I've got 70 times 1,000 times 12. That's $840,000 plus 15 times 1,200 times 12 is $216,000 plus 2 times 1,500 times 12. And that equals $36,000. Everybody okay with all those numbers? So if we add all that together, I come up with $1,092,000 for a gross potential income. We all okay with that? That's my gross potential income. Now I need to subtract my 12% vacancy. I need to, except my computer won't let me do it. There we go. All right, I need to subtract my 12% vacancy. So minus 12% times 12% is going to be 131,040. So minus 131,040. $960 for gross effective. That's my gross effective income. And now I need to subtract all those operating expenses. So minus that management fee of $96,096. That's my 10% management fee. Minus $43,500 500 and minus a big whopping number, $142,000 times 12 would be
Who did that? You did. Good. Who
704,000.
else did?
We have managed this property very poorly. We have allowed our expenses to get out of control on this property. So if we take $960,000 gross effective income and we subtract 96 minus 43,500 minus 1,704,000, and we end up with a negative $883,596 operating loss. If you are that bad at your job, quit. Okay? If you ever manage a property that has an $883,000 operating loss, it's time to do something else. Yes, if you don't quit, they will fire you. Yeah. I don't know exactly what kind of expenses you have for $140,000 a month.
I'd be looking at
Yeah, right. There's something funky is going on. Now, if you only did the $142,000, it would be 960 minus 43,000 minus $142,000. So if you had done it the way I intended it, not the way I actually wrote it, you would have come up with $679,364 as an NOI. Does that sound familiar for those of you that did it not times 12? No?
So I have a question. So the property management fee, I think I got stuck on that. It says it's 10% of GPI.
Yeah.
So I think I did the 10%. Maybe I did.
Oh, it does say 10% of GPI. You're exactly right. That's another mistake on there. That's another mistake. Yep. So that should say what? 10% of what?
The GPI.
The gross effective income.
Okay.
So if you follow those directions, then good for you. If you were paying attention to that much.
Okay.
Yeah.
I got
So
that.
I thought I was thinking, okay. All right,
Yeah.
so it's
But a property management fee is always going to be collected based on what?
yeah.
Gross effective income.
Okay.
Yeah.
All right. I did. Okay.
Gross effective income.
I found that a little strange right from the start.
Apparently I was a few drinks deep when I wrote this question.
Alcohol, I couldn't.
Yeah, hey, something had
Question two.
something had kicked in.
You started early. It could get worse.
You assume I ever stop, you know? I have found that continuous medication is the best way. All right, let's see if I did better on number 3. A commercial development rents office condos and has 90 such units that each rent for the same monthly rate. The property has the following characteristics. Monthly debt service payments of $13,250, annual before tax cash flow, property management fee. They give us all the data. And ultimately, here's what they ask us for. Based on the above information, which of the following is the most likely monthly rental rate for each unit? Now, I could spend a bunch of time teaching you how to work these questions in reverse, but I put this on here for a very specific reason. Sometimes you need to get out of your own head and stop being so focused on how do I do this and focus on the fact that one of those answers is what? Is right. Can't you, at bare minimum, plug those answers in until you find one that works for you? If you know how to do the formula, can't you do that? Yeah. Now, there is a way to set it up and work it in reverse, because you'd be dividing by the remaining percentages to back out of it. But what I want to demonstrate, I gave you that question for a specific reason, is to show you that sometimes when you get stumped on a math question, the best thing to do is to start plugging in what they've given you and see which one makes sense, which one works out. Does that make sense for everybody?
You get 4 tries of it.
That's right. Yeah. Well, and so what I would probably do if I was honest, I'd probably start with the smallest one. And then if that was not enough, I'd go to the biggest one. then I'd see how far off I was, to, you know, if it wasn't either one of those, I'd figure out how far off I was, which one I needed to try next. That, I mean, that would be my kind of process of elimination. So, you know, again, it's all about writing a formula out. You know, gross potential income minus vacancy equals gross effective income minus operating expenses, and that equals NOI minus debt equals before tax cash flow. So which one ultimately did you settle on? You settled on number one? Okay. You know, so let's just plug in number one and I'll show you what I mean. And then you can see that any other one won't work. So if you plug in number one, well, let's first of all fill out the information that we have. Monthly debt service payments of $13,250. So we're going to write down $13,250 times what? 12, because it's monthly. Then annual before tax cash flow of $175,600. We'll fill that in. Again, we're not accustomed to being given that, but okay. $175,600. There's our before tax cash flow. Property management fee of $78,000 annually. That goes on the operating expense line, right? $78,000 property management fee. And other operating expenses of $365,000. So we just fill in that $365,000 on operating expense line. And 10% vacancy. So if we plug in number one at $800, that's going to mean our GPI is going to be 800 times, how many units? 90 units times what? Times 12. So if we do the math with that, 800 times 90 times 12 would be $864,000. Minus 10% vacancy, so minus $86,400 in vacancy. And what does that give us as a GEI? $777,600. $777,600 for gross effective. And then we start subtracting out our operating expenses of $78,000 management fee minus $365,000 in other operating expenses. And that gives us an NOI $349,600. $349,600 for an NOI minus a debt service, which is $13,250 times 12, so that's $159,000 in debt service. And if we do that math, that leaves us with how much of a before? Why does that not work out? Did I do something wrong?
Yeah.
334,600.
What did I leave out of?
Net operating.
Oh, 334. I typed something wrong on that then. Thank you. Don't mind correcting me, because I can easily key it wrong when I'm doing it too. All right, so let me do that again then. I got gross effective income of $777,600 minus $78,000 minus $365,000, $334,600. That sound better? Thank you. And then minus that debt service of $159. Gives me $175,600. How's that sound for everybody? It's the one that works. And so if you'd plugged in 820, you would have ended up with a before tax cash flow of too much money, right? And of course, if you plugged in, if you plugged in 760, you would end up with not enough of a before tax cash flow. So it's the one in between. And so on a question like that, now here's a way to work it backwards. If you really want to know, if one of those people absolutely has to know how to work something like that backwards, well, it would have been your before tax cash flow plus your debt service would give you NOI, right? And then you could have added in your operating expenses, which they gave you, and that would have gotten you up here to gross effective income. All right. So once you got here, you would have maybe reached your stumbling block, right? Because what you would have had to done is divide this number by 90%, because you would have to divide by. Remember, like the seller net questions, where you take a percentage out and you divide by what's left over. It's the same idea. So you would have divided that number by 90%, which would have given you the gross potential income of 864, and then you could have just divided that by the number of units, and it would have given you $800 a month. But what I want to show you is it's not necessary for you to reinvent the wheel. If you know how to work the formula straightforward, just take the time to plug the numbers in. Rather than trying to spend time studying and learning something different, just know that the skills you already have can answer this kind of a question. Does that make sense for everybody? Same thing is true with the seller net questions. I've had people who get stumped on the seller net questions and they forget, oh, I got to divide by the remaining percentage. Remember, one of those answers is the right number, right? So if you start plugging their answers back in and just saying, okay, well, if they sold it for this much money and they paid a 6% commission, how much would they have left over? If it lines up with the question, then that's the correct answer. So you can always do that on the math problems as well. Check yourself and or solve something you struggle with. Yeah, go ahead.
I'm working backwards.
Yep.
About the division, but I came up with like 791 or 796, so I felt like I'd done it correctly because it said rounded to the.
It would, right, and it will not be perfect in most cases. It won't come out perfectly, but if you had tried it would be by far the closest to any of their answers, right? If it comes out to 796, then obviously it's not going to be 820. It's not going to be 760, right? So and that's the other thing. It very rarely is it going to come out to be something perfect, especially when they're asking you to round your answer.
Right, so I thought, okay, I've done it. So.
Yep. Okay, everybody okay? Feel good on that one? That's a pretty difficult question. If you're okay with that one, then you can definitely handle a before tax cash flow question on the exam. That's about as difficult as I can make that question by sort of asking it in reverse. Because what ends up happening is most people just freeze. They're like, I don't know how to do that. Versus thinking, well, I do know how to do that. Even if I have to take the long route and just plug things back in, I know how to get there. Like with a seller net question, you can just start plugging in their answers and see which one works out. Only one's going to work. Okay? All right, then let's look at the profit, loss, and return on equity questions that you have. All right, the homework section on here. Number one says Tom purchased a property for $115,000 and sold it years later for $186,000. What is his percentage profit on the sale? So remember, when we do these kinds of questions, when we work these, we've got a T-bar formula for profit that looks like this. The T-bar for profit has on the top the dollar return or profit. Remember, that's the same thing, right? And what's on the bottom? The original investment. And remember, we said our original investment is always our what? Our down payment. It's not the purchase price necessarily, it's the down payment. Now in this case, since they didn't say anything about a loan, we have to assume that the original investment was the purchase price. But if they had said a loan was involved, which would you use? Purchase price or down payment? Down payment. That's why it doesn't say purchase price here. That's why it says investment, because the investment is whatever money we pull out of our pocket. Okay? And then that gives us the rate of return. Okay? And in this question, they want to know the rate. That's what they're looking for. Is everybody okay with that? They're looking for the rate. So, our dollar return. that's going to be what we sold it for, 186, minus what we paid for it. So we paid 186, sold it for 115. You agree with a $71,000 profit on this thing? All right, so that goes in the top of our T-bar. And our original investment is how much? What we paid for it in this case. So $115,000 is our original investment. So that means the math is going to be $71,000 divided by what? Divided by $115,000, and that equals 0.6174, and we have to multiply that times what? Times 100, because it's a rate, so 61.74% profit. Is everybody okay with that? And we know it's a profit because we made money. If we had lost money, it would still be the 61%, but it would be a loss. If you had a negative number, it would be a loss. Yes, sir?
I was going to round to the nearest next one on this one.
You're not rounding to anything. It didn't ask you to round.
They're like 6.1, so
No, I said 61. I didn't say 6.
I'm saying.
Yeah. Again, on the test, that neither one of those is a different answer. Because on the test, it's probably going to say 61%. You know, don't stress about rounding. Okay? Don't round. Your answer is don't round. You know, and because if you don't, what did I say? Just always go 4 past it. Right? If you go 4 past the decimal, you're not going to have to worry about the rounding. And then when you finally got an answer, then go back and round it the way they want it now. Okay? All right, number 2. Sally sells a home for $428,000, which she purchased previously for $445,000, obtaining a $450,000 or $400,500 loan at the time of purchase. What was her percentage loss on the sale? So this one is a little bit more complex because it involves a what? A negative number and a loan. Because our investment on this one is not the $445,000. How much is our investment on this property? How much is our investment always? It's our down payment, right? It's our down payment. It's not what we bought it for. It's not what we sold it for. It's how much money we pulled out of our pocket. So using the same formula, on the top we've got our dollar return, which is always the difference between what we bought it for and what we sold it for. Does that make sense? So, and then on the bottom we've got our original investment, and then our rate of return over here. And again, they want to know the rate of return. So, working through what we need, the dollar return. What we sold it for is how much? How much we sell it for? $428,000 minus what we paid for it, which was what? $445. Remember, you're not in the second grade. It's not big number minus little number. It's whatever you sold it for minus what you paid for it. So we had a loss of $17,000. That make sense for everybody? So our return is that negative $17,000 or a $17,000 loss. That's all the negative means. It's just a loss. Our original investment is not what we paid for the property. Our original investment is our what? Down payment. So to figure that out, we have to take what we paid for the property, which is $445,000, minus the $400,500 loan. Does that make sense? Okay. Again, nobody cares as an investor what they paid for the property. They care how much money came out of their pocket. And in this case, that was $44,500. $500 invested. That make sense for everybody? And so that's the number that goes in the bottom of our T-bar right there. So the math is going to be a negative $17,000 divided by what? 44,500. And that is negative 0.3820 times 100, which is going to give us what? 38.2% loss on that transaction.
All right, who got that right?
That's a tough one.
I got it wrong.
What'd you use, the purchase price?
I did.
You use the purchase price.
28.
Now, the purchase price would have been the right way to go if there had not been a loan involved. Because if there had been a loan involved, the investment would have been the cash sales price, right? But here's the thing. The way this person is going to look at this is that they took $44,500 out of their pocket. Does that make sense? They only put $23,000 back in their pocket. They're not going to look at it and say, oh, well, I lost the bank's money, because guess what? The bank didn't lose any money, folks. What happened to the loan? It got paid off. All of the loss was borne by who? The seller, the investor. And that loss wasn't taken on $450,000. That loss was taken on the $40,000 that they pulled out of their pocket. Does that make sense? And any way you shake it out, they lost almost half the money they pulled out of their pocket. And that's why this is a 38% loss. Is that kind of clicking with you? That's why I say your down payment is your investment. Yes, ma'am.
So it's what you said what they bought it for and something else. I missed the second part.
I don't know where you are in your brain. You're running a loop in your brain, and I'm not there.
The T-bar.
Okay. What goes on top of the T-bar?
What you bought it for and then what?
So we call that the return, right?
Okay, so
that's the return. The return is the difference between what we bought it for and what we sold it for. That's just a straight up dollar and cents profit. What we bought it for, what we paid for it. We don't care about the loan when we're talking about the return. Okay? We care about the loan when we're talking about the investment. Because here's the thing. The bank didn't take a loss. How much did the bank invest in this thing? $400,500. How much did the bank get out of this thing? $400,500. So that's dead even money, right? Any profit or loss is going to be realized by the investor. And so that $400,500, we need to take it out of the picture, because the profit and loss all happens around this $44,500, because that's the money that was actually invested in the transaction by the buyer. It doesn't, on the bottom of that thing, it doesn't say purchase price in that form. So here's the thing. You got to memorize the formula. You got to get that formula nailed down, because you got to know on the top it says the return. And you got to know on the bottom it says what? Investment. It doesn't say purchase price, it says investment. That means investment is how much I dig in my pocket and pull out, not how much I paid for it. What I paid for it is a fake number. I don't care in investment real estate how much I paid for it. In fact, it's really a fake number for all of us. How many of you really give a crap what you paid for your house? It doesn't matter. What matters is what? How much I pulled out of my pocket and how much I'm going to put back in my pocket when I sell the thing. Does that make sense? You know, I love to hear people all the time that do 100% financing. And they'll be like, man, I did pretty good. I made $10,000 on my house. I'm like, pretty good? You did amazingly fantastic well. You invested nothing and you walked away with 10 grand. That's not an investment, that's a gift. Does that make sense? Because who really invested the money? Who took all the risk? The bank did, not the owner. Are you kind of getting that? I'm trying to get that idea that your investment is not the purchase price, your investment is your down payments, whatever you pull out of your pocket. Okay? All right, number 3. Andrew purchased an income-producing property for $1.2 million and obtained a $960,000 loan paying the balance in cash at purchase. The property generates an annual before-tax cash flow of $26,500 after all operating expenses and debt service is paid. Based on this information, what is Andrew's annual return on his equity investment? So, again, look at the question. What are they asking me for? What is my return on equity? That's a fancy way of saying what is my return on investment. And return on investment is exactly the same formula that we've been dealing with all the time, right? Look at it. It almost says, literally, return on investment. What's on the top? Return. What's on the bottom? Investment. So that is the formula for. Does that make sense? That's the same formula for return on investment. Because really, isn't a profit just a return on an investment as well? A loss is a return on an investment. Okay? So it's the exact same formula that we've been dealing with the whole time here anyway. Give myself some room to groove here. There we go. Alright, so what's his return on his equity investment? The first thing I need to do is write my formula out. So I've got my formula here. On the top, I've got the dollar return. On the bottom, I've got my investment, my original investment, and then my rate of return. And they want to know the what? Which one of these three do they want to know? They want to know the rate of return. What is my rate of return? The annual return on equity is return on investment. That's a rate. Okay? Now let me ask you a question. What is my annual return in dollars on an investment property? Tell me in words, not in numbers. It's the before-tax cash flow. The return on the investment, the money I put back in my pocket, is my cash flow. It's my. Does that make sense for everybody? If I own the property, the whole reason I do that big, long accounting is to see how much of a return I'm getting on that investment. Is everybody following me on that? So, my dollar return right here is going to be the same thing as my before-tax cash flow. And my investment, like always, is going to be my what? My down payment. Okay? So now let's see what we've got up here that we can deal with. It says Andrew purchased an income-producing property for $1.2 million. That doesn't help me because that's not my investment necessarily unless I paid what? Unless I paid cash, and obtained a $960,000 loan paying the balance in cash. So I do have a loan. So in order to calculate, in order to deal with those numbers, what am I going to need to do? I need to subtract them so I can see how much my actual equity investment or down payment was. Does that make sense? So $1.2 million minus the $960,000 loan. What is that, $240,000?
Yes.
So that's a $240,000 investment or down payment. So what I'm going to do is move that one right over here. That goes to the bottom of my T-bar. Is everybody okay with that? Alright, so I'm done with all that up here in the question. I can mark it out. The property generates an annual before-tax cash flow of $26,500 after all operating expenses and debt service are paid. So do I need to do any math with that? Nope, they gave it to me. So my before-tax cash flow is $26,500 right here for my return. So what's my math going to be? $26,500 divided by what? $240,000. And if you do that math, hopefully, we can come up with a rate of return. I get 0.1104 times what? 100, because we're calculating a rate. So what is that for a rate of return? 11.04% rate of return. Are you starting to see that? Are those numbers starting to make a little bit of sense to you as far as rate of return goes?
That's not a good percentage though, right?
11% is pretty good for an annual, because that's 11% annually. And so 11% annual return is a pretty dang good investment. Anything above 10 is pretty good for most properties. Now, of course, you know, you're going to have another return when you sell the property, right? You'll have another profit. Presumably the property will be worth more money when you sell it than it was when you bought it, so you'd have another profit there. But for an annual return, 11% not bad.
Keep it in mind, you're gonna have, hopefully, appreciation.
Well, right. Hopefully the property's going up in value as well, and that would be a return you'd realize when you sell the property. But this one you're getting back annually. So that's really no different. At that point, you look at it as to compare how you could do compared to the stock market, for example. If your money in the stock market would generate a 10% return, well, this would be better. If your money in the stock market would generate a 15% return, then you'd rather have it invested in the stock market. Because as an investor, that's really what you're weighing out. Where's the best avenue for me to place my investment at any given time? All right. Number 4, finally. So the property has an annual gross effective income of $728,000, operating expenses that total $296,000, and debt service payments of $280,000 annually. The owner made a down payment of $900,000 when he purchased the property for $9 million. Based on this information, what's the annual return on equity investment for the owner of the property? Isn't that the same question we just answered? It is. It's the same exact question. And so the T-bar looked like on the top it was the dollar return, which we said was the same thing as the what? Before tax cash flow. And on the bottom it was our original investment, which we've said is always what? The down payment. So we've got the down payment here. Okay? And then that would give us our rate of return. Is everybody with me on that? So let's look and see what we've got here. So the property has an annual gross effective income of $728, operating expenses that total $296, and debt service payments of $280 annually. Is any of that the before tax cash flow? No, but will it get me to a before tax cash flow?
Yes.
It will, and that's what I'm going to have to do in this question. I'm going to have to calculate my own before tax cash flow. So we know that that formula is gross. Can't write with a highlighter. We know that formula is gross potential income minus vacancy equals gross effective income, or effective gross, minus operating expenses equals NOI minus debt equals before tax cash flow. So here's the information they gave me. Has an annual gross effective income of $728,000. Well, I don't need to do any math with that, I just need to write it down. Operating expenses that total $296, so minus $296. Says the owner, and debt service payments of $280,000 annually, so minus $280,000 in debt service. Based on that information, can I get to a before tax cash flow? Yeah, because I can do $728,000 minus the $296,000 to get an NOI of $432. And the NOI of $432 minus the $280,000 in debt service payments gives me a before tax cash flow of $152. And that number goes right over here into my dollar return in my formula. Does that make sense for everybody? That's my before tax cash flow. Now the only other thing I need to know is my original investment. It says the owner made a down payment of $900,000 when he purchased the property for $9 million. Which one of those two numbers do I care about? I care about the down payment. So my original investment is $900,000 The math is going to be 152 divided by 900,000. 152,000 divided by 900,000 equals 0.1688 or 1689 times 100. So what's our return on this thing? 16.89%. That's a really good return. It's a fantastic return. Is this math starting to click? Because that's as complex of a question as you can see on that. So we've seen at the end of these two worksheets the kind of question you could expect to show up on an exam for these two chapters. You know, if you can handle the last question on each one of these worksheets, then you got this math in these two chapters knocked out, and you're going to get those questions right on the exam. If you've got stumbling blocks along the way in those two questions, then we need to look at where those stumbling blocks are, because these are great rate of return type questions. So pretty good? Good. Good. I think at this point everybody's got that formula nailed down, right? You know, it's just a repetitive thing. The more you say it, the more you write it, the more you repeat it, the more you get. And I find it really helpful to write it out when I'm doing one of these questions and just kind of put everything where it goes and then come back and do the math with it. It helps keep you organized with it, especially when they start giving you, certain things that you do need, certain things that you don't need, because sometimes they're asking you for NOI and they give you the debt service payment. Well, yeah, I'd love you to recognize automatically, okay, well, if they're asking me for NOI, I don't need debt service. But if you've written the formula out, you see it visually that you don't need it because it's after where you need to be. Okay. Last thing you took home for homework was the quiz, right? Stop and start this video. So I've got a break here. Upload them separately.